Hi, everyone. As you're coming in, we'll go ahead and get the legal housekeeping done while you're coming in here. My name is Marcia. I'm the webinar director here at Advice Chaser, and we want to say welcome. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation today. Attendees are muted, but we encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the webinar today as appropriate. We do have a question and answer period at the end. If you have a question and we don't have a chance to get to it, please go ahead and leave your phone number as well in the chat box. We'll make sure someone reaches out to you after today's event. So once again, we want this experience to be as educational as possible. Please don't hesitate to ask for clarification or expansion of the material. We've got some great people here who can address those questions. So I'd love to introduce you to our guests today. Our moderator is Brian Ferrangi, and as a principal wealth manager and founder of Ferrangi Financial. Brian created a practice for clients that truly appreciate a personal relationship with a seasoned practitioner who intends to stick with them for the long term. As a certified financial planner, Brian helps clients design a customized vision for retirement by listening, asking insightful questions, and offering expert advice. Brian graduated with a Bachelor of Science degree in finance with an emphasis in personal financial planning from San Diego State. And while not at the office, Brian keeps a healthy work-life balance by exercising, enjoying a game of chess, and spending time outdoors with his family. So Brian, go ahead and say hello so people can see you on the video.
Sure. Hi, everyone. Like she said, my name is Brian Ferrangi. I'm excited to be here with Michael Bovee, our panelist and guest speaker today, and I'll be moderating. So I'm looking forward to having an engaging conversation with Michael in particular, and hopefully educating all of you out there on the topics that we have in store for you today, namely taxes and estate planning in particular. So I think we'll probably jump right in, and I'll frame it by saying that there are some looming things that are coming here in the near future, potentially down the pike from Washington, D.C., and that really does set the stage for some potential urgency for action in terms of engaging with a conversation with some professional wherever your local demographic is. But hopefully today's educational content will prompt you to think of things perhaps in a new way. There will certainly be some, we'll start from the ground up. In other words, we will teach you, or in other words, Michael will teach you Estate Planning 101, then we'll graduate to perhaps the middle territory, and then we'll move on to more advanced topics that Michael's going to get to today. So I'm very excited to be in this conversation with Michael, who I'd like to introduce to you now. He's the principal and CPA for a company called Glenn Burdett. Unless, Marcia, were you going to do the introduction, or is this okay?
Absolutely. You're welcome. You're welcome to read that out.
The bio as well as you do. You might want to do that for him. But anyway, I know enough about Michael to be dangerous, if that's all right.
Well, Michael's a principal with Glenn Burdett. He was hired straight from Cal State, and where he has since enjoyed working his way up. He's best known as a trust guy or a nonprofit guy, and loves the challenge of helping clients navigate an ever-changing tax landscape, kind of like you mentioned there, Brian. Originally from Red Bluff, Michael says he and his wife, Jen, fell in love with the Central Coast during their time at Cal Poly. And he also enjoys volunteering in the community and also outdoor activities with his wife and kids. So Michael, without further ado, we're ready to turn it over to you.
Excellent. Well, thank you. And yeah, I'm excited to take a break. I have 4 kids running around chasing them all the time, but we get to take a break and talk about a fun topic today, and that's estate planning. So this is one of the areas that I actually really enjoy, and even thinking about my family and my kids, and thinking down the road as far as, where are we going, and what do things look like, even beyond my time. And that's really our goal for today. You can see it there. Our goal is to just understand the estate planning as a whole, identify specific concerns, as far as for you and your situation with your family, with whatever you have going on in your life. And then understanding the landscape right now that's changing, quite a bit with proposed legislation. We're expecting something to come through. We don't know exactly what that will be, but we can talk a lot about that later, and kind of seeing, okay, how might that impact you, and what should you be doing now, to get ready for that. So kind of diving in, just that basics of estate planning. I really want to take a step back. Brian, you noted we were going to kind of start with the ground up, and I think that's the best place for estate planning is to back up. A lot of times, we hear there are tax proposals out there. There's something that's going to impact an estate tax or a death tax or something like that, and we start worrying about the tax situation. But we really need to back up for a moment and think about all the different areas of estate planning, and meaning that it's not just the tax situation, but it could be some of the nuts and bolts of who's going to make the decisions, as you're at the end of your life, that might be helping you out, who's going to be a trustee or an executor that might be making decisions for you before or after you pass away. To who's going to be signing the documents for you, and who's going to be filing tax returns on behalf of you and your estate or your trust, who's going to take care of those things. It might be saying, who's going to take care of my Facebook account? I don't know what's going to happen here. I need somebody to step in and think about that. So we really want to look at this as an overall picture, holistic planning for what's going to happen after you pass away. And it might be, what kind of legacy you're leaving in your family, in the community, what happens with your assets, all of those different types of areas, kind of looking at each one. And then obviously today, we're going to focus in on some of the tax planning side of things. So, as far as your focus here, we have different groups of people who might be listening here. And what I encourage you to do is step back and think about this. What do you want your legacy to be? And every situation is going to be different. So you might be a small business owner. A lot of our clients are small business owners, and they're looking at, if we run a small business, how do you pass that on to the next generation? What's the succession plan that you need to put in place? And maybe that's the focus, for estate planning right now. That's the biggest area of focus. Maybe it's saying we want to pass things on to, our assets on to specific people. Sometimes you might want to say this house or this piece of real estate is really special to our family. We want to make sure this sticks around, and the cabin that the family's gone to for generations, we want that to stick around. We want future generations to be able to enjoy that asset. How can you plan? How can you set that up, to be able to do that? What are your priorities is really what we're getting to. And so that's kind of the nuts and bolts of building your legacy is, figuring out what are your priorities, whether it be charitable, whether it be, some certain relationships, family, or some friends that you want to provide for, or pets sometimes come into play that you want to make sure they're taken care of after you're gone, what kind of financial or tax considerations as well. So we're trying to put all of those different considerations together to say, what is your real legacy? As you look through your different kind of assets, we have different categories of those assets. And a lot of times the issues that might pop up after someone passes away with, multiple beneficiaries. Maybe there's multiple kids or grandkids or things like that. Sometimes the issues are looking at dollars and everybody wants their fair share. But a lot of times, arguments or disagreements amongst family members is going to come from maybe relatively invaluable things. It's the personal items. It's, who gets that family heirloom, who gets that, those old photos that have been saved forever, that family book, who gets that, that necklace or that piece of jewelry that came down from great grandma, and that's the type of thing that can become contentious too. So you need to pay attention to, both the things that are lying around the house on a shelf somewhere, that might have some sort of memories attached to them or some sort of value that way. And then you also need to plan ahead for making sure you have liquidity. And so thinking about what you want to do with your assets, whether that's retirement accounts, and you think about how those might come out in the tax situation of those different accounts. You might think about the different real estate items, business succession, like I mentioned, and digital. I mentioned a Facebook account, but do people have access to passwords and accounts? And they know, how are they going to be able to access those different accounts to either be able to shut them down or to be able to get contact information or to be able to work with your different banks and investment institutions. And, then a second question at this point in time, in your life before you pass away, how much control do you want to retain, now as we get into some of these planning discussions? Some of the things we're going to talk about in terms of trusts or gifting, it comes down to how much control would you like to retain during your lifetime over all of those assets, over some or all? And then after you pass away, how detailed do you want to be? So I have, some clients I've talked to, and they say, I want my last check to bounce, and that's one strategy for planning, or well, let my kids fight over it after I pass away. I don't want to get too detailed. And then you have other clients who, are going to say, no, I want X amount of cash flow to come out to my kids, and then I want it to go to my grandkids, and I want to benefit these specific charities, and they can get very detailed for a very long period of time, and say, I want this to go out for a period of years or, decades, and we can set up trusts and control that after death as well. So there are a lot of options, but the first step is really thinking back on what do you want it to look like? Because, as you talk to different advisors, there are a lot of different options there. And you really need to get the tailored advice and the tailored, planning in place that meets your goals and your individual needs.
Hey, Michael,
I don't know if that makes sense.
That does make a lot of sense. Yeah. And I was just going to ask now, on our side, we do a lot of planning in advance, or at least we aspire to. But have you seen much in the way of when it goes wrong or problems to avoid or things that are common pitfalls that you've run across in your time that you think might be worthwhile to educate people about, how can it go wrong if I just ignore this altogether and let it go to chance?
Sure. Yeah, great question. Because it does go wrong. And, that's not, when it does go wrong, it ends up being really costly all the way around in terms of relationships and, people not getting along, in terms of, having to have attorneys and accountants and things like that, and, petitioning the courts potentially, to work to resolve things and get it settled. And so, really, I think not spending the time to think about what you want things to look like after you pass away, that's probably the number one thing, is saying, no, let them figure it out later. Or just saying, you know what, that's an uncomfortable conversation. I don't want to think about dying. I don't want to think about the end of my life, And so the number one pitfall or number one mistake is just setting it aside. So the fact that people are, listening to a webinar where we're talking about this now, I mean, you're on the right track. And then just make sure you actually do something about it. Get the planning in place. You can update things as you go. Make sure that you stay flexible. That's the other tip that I would say. is sometimes you see things get locked into place, and people are concerned about tax impacts, and I appreciate that. I'm a CPA. Tax is my area, but I always try to tell clients, you don't want the tax tail to wag the dog, right? I mean, going back to that thing. So, we're really trying to say, okay, don't lock into something that you might regret later. If you think this is something that's going to change, it's not a long-term value or priority, and you want to be able to change it, then, make sure you plan for that, because otherwise some of these structures can be irrevocable. And so trying to make sure that you're keeping the flexibility in mind as well. As far as transferring assets, that's really what we're going to focus on today. And that's really what most attorneys or CPAs, when we talk about estate planning, we're talking about asset transfer, meaning, most of the time those small items, the memorabilia or collections that you have in the house, isn't that going to be as much of an issue. We're talking about your financial assets, your retirement accounts, your investment accounts, your real estate, your businesses, things like that. We're saying, how do we account for those? How do we do that in an efficient manner, meaning in a tax efficient manner and in a cost efficient manner, if that makes sense. So that's not always just the estate tax that we're worried about. We're really looking at a blend of estate tax and income tax, and also, costs, that may come in terms of, how complicated is the setup that you're doing. If you're creating trusts all over the place, for a very small amount of assets, does that make sense? Are you in a place where you might end up spending a lot to maintain that planning, and you might not have as much benefit from it?
Michael, on that note, back to the question of transferring assets, you mentioned earlier that liquidity is a big issue. From my perspective, I can certainly see that in my day-to-day conversations as well. And in particular, can you speak to perhaps one aspect of it being the taxes due on either a piece of real estate or even an IRA account, where there's going to be a hefty sum of money that the government's going to come calling for, and that you're obligated to deliver if you're the inheriting either the kids or the heirs of that estate. What are some ways that you can think of to mitigate that risk of needing liquidity and you don't have it, or providing for that?
Yeah, there are different ways to mitigate, for asset transfers in terms of being able to pay tax. And, when you talk about a retirement account, most of the time we're talking about a traditional or taxable retirement account, say like an IRA or a 401k. So setting Roth accounts aside for a second, because they're treated after tax. If we're talking about a traditional account that's going to be taxable, we're often more concerned about the income tax. Depending on where the estate is and the overall value of the estate, we may or may not be concerned on the estate tax side of things, but the investments in there, might provide for some liquidity if there was an estate tax. But, if you have $1 million IRA, that's fully subject to income tax, and you leave that to a certain beneficiary. Well, that beneficiary is going to have to pay income tax on that full balance. And something to keep in mind is that, if you have $1 million, investment account that's not in a retirement account, and you have $1 million IRA, and you have 2 kids, and you give one account to each of them, something that you should keep in mind, or your planner should help you, to consider, is that the IRA beneficiary is going to have a net value that's much lower, because they're going to be paying income tax on that. And so, they, depending on their tax rate and how they withdraw the money and over what time, they might pay, let's say, an effective rate of 35%. It's just a ballpark discussion. Federal and state taxes on the IRA. Well, that's $350,000 that eventually over time comes out of their IRA, or out of their $1 million IRA. So that leaves $650,000 that that person inherits. Whereas the other child that would receive the $1 million investment account or cash account or piece of real estate, they're getting that full value. It's not subject to income tax. So the tax situation on those assets is really important. And then in terms of liquidity, if you do have to pay and you don't have the, if let's say most of your assets are in real estate or locked in a business for small business owners, there are a couple provisions. Number one would be considering something like life insurance to be able to fund the tax payment. And there are some things that we'll talk about later, like life insurance trusts that we sometimes use to try to keep the life insurance out of the estate if we're worried about estate tax. If we have an estate tax, we don't want the life insurance to come in and increase it. And so you need to plan ahead, and there's a way that you can do that with life insurance trust, although there's some questions about that with the new legislation being proposed. Or there are some provisions in the tax code that you can pay over a longer period of time. And depending on the type of business, it's even more advantageous on the farming side of things. You can pay the estate tax over a period of years so that you hopefully don't have to sell the business or sell the real estate or farm or whatever that is to be able to pay for the tax. Does that make sense?
Yeah, I think that's what I was hitting on. You hit it just right. Thank you.
Good. Well, let's back up to just we're already getting into kind of some questions and going with trust, talking about trusts and life insurance trusts and different things. So let's back up and go over just some brief definitions. I mentioned you want to keep probate costs down, which is really what probate is. It's the court process of proving that the will is valid. And so if somebody passes away, you're basically saying, okay, what do we do with their assets? If somebody just has a simple will set up or no will at all, then the court is the one who's going to determine what happens with those assets. And especially in California, where we practice and most of our clients are located, they're going to be subject to California probate rules, and those are going to vary state by state. So if you have assets in a different state or residency in a different state, you need to make sure you look at those state rules, those specific state rules, and the costs associated, which generally the court's going to set percentage fees for probate. And there's court fees, probate fees, and then there's attorney probate fees. And then you have to go through a fairly complex accounting process to be able to go through probate and provide the court with an accounting of everything that's in the estate. And that's a costly process as well. And so the biggest issue with probate is, that we are trying to mitigate for our clients is to say, we want to keep the costs down as you go through that, and we want that to be efficient. We also want to make sure that your desires are carried out, and that you're not subject to, what happens in a court process and these arguments that go back and forth, and you have a little bit less say or less control. And third, that court process is pretty public. And so there are sometimes, some privacy concerns. Do you want all of your assets and everything kind of dragged out into the open, as it were, or where people could search and find some of that information? It's kind of a public process, whether that be on the relational side of things or just, with all of your assets and everything that you have going through the courts. And you see that sometimes in some, you'll see headlines because on occasion you see something like, Prince passing away or something like that, where, all of a sudden there's a court process involved and it becomes very public and well known. And so we want to try to mitigate that, that probate risk for our clients. And the main way to do that is by using a trust. And so if you have a will set up, but if you have a trust set up as well, then what the trust will do, and this is true for some certain other assets as well that are exempted from probate, but trust assets basically set up a separate legal entity, this trust that can carry out your wishes. And then the court doesn't have to approve that. if it's already set up in a trust, if you've already have that documented together. That's also true. You mentioned retirement accounts, Brian. So it's also true with designated beneficiaries on retirement accounts. Those aren't subject to probate. And so there are certain exceptions like that, some minimal amount of cash, typically your primary residence, some things, some assets are able to go transfer directly without going through probate. So you want to be cognizant of that. And most of the planning that we'll do would involve getting a basic trust set up. And typically that's going to be a revocable, a revocable living trust that you would set up during your lifetime and be able to change as you go, to carry out your wishes, after you pass away. Now, moving on from probate, we want to spend probably the bulk of our time talking about estate and gift tax, as we talk about transferring assets. And, when we talk about estate and gift tax, sometimes it's referred to as the death tax or different things, or different names out there. But the basic idea is that when anyone passes away, there's a look at the value of your assets, and passing those assets on to the next generation is basically a taxable transaction. And when we talk about a lifetime exemption, typically people will say, okay, well, we have that lifetime exemption. We can, right now it's at $11.7 million per person during 2021. That's one of the items that's proposed to change. And so $11.7 million per person, lifetime exemption. Well, technically, it's as we go through tax, when somebody passes away, all their assets are basically taxed. But if it's under the equivalent of $11.7 million in assets, which equates to a tax credit that would cover about 11.7 million of assets, then there's zero tax. Okay, so that's how that works out, and that's on all the gifts that you've done over your lifetime and any assets that you own at death. And I'm oversimplifying here a little bit, for our discussion, but that's the basic idea, is that you can give away up to that currently $11.7 million in assets during your life, and or own that much in assets when you pass away. And so if you have gifted $1 million and you have $10 million left in assets, and you pass away, during 2021, then that $11 million is under the $11.7 million exemption, and therefore there is zero tax as far as an estate tax goes. All the $1 million in gifts would have already been gone to beneficiaries, but the 10 million that's left would then get divided up and go out either through your will or your trust, to beneficiaries. And that value at 10 million, that would be their basis, generally speaking. Now, there are some exceptions on that, like we talked about retirement accounts earlier, where there's income tax that's due. But generally speaking, there's what we call a step up in basis to the value when you pass away. And so that's what we talk about when we talk about the lifetime exemption. And normally when we're talking about estate and gift tax planning, we're considering, if any married couples, we're considering it as a couple, because there's what we call portability. This came into play, back in 2010. And what that allowed, married couples to be able to do is to transfer any unused portion to the surviving spouse. So in that scenario that I just mentioned, where let's say I pass away and I used up $11 million, there's $700,000 that's left. That would be portable, and that would go over to my spouse. So my wife, Jen, would have her $11.7 million, and then she would get $700,000 from my estate carried over as well. Then at that point, when she passes away down the road, she would have to look at what's the current law for her, and whatever the estate tax lifetime exemption is for her, she would get my $700,000 added to that at that point in time.
Michael?
A bit complicated. Does that make sense, Brian?
Yeah, that's perfect. And can I throw in the question that's probably on a lot of people's minds, which is, if your estate is greater than 11.7, or if you're a couple, twice that, so 22 and change, what is the tax rate that your estate would be hit with for all dollars above that threshold?
Yeah, so right now it's 40%, there's been some discussion around it, but there's no current legislation proposed to change that. So 40% is generally what you can plan on as the estate tax rate that you would pay tax on after that 11.7 million per person. Got it.
And then I had a question come in here from someone in the audience that's asking, back to your earlier comments about trusts and wills. They were just asking if there's a particular minimum estate size that for folks that should consider a trust, or is there not a minimum in your mind as far as when is it appropriate to consider a trust?
Yeah, that is a good question, because it's there's some nuance to it, in that, you know, it depends on the assets is really the answer. It depends on the situation of that beneficiary. So there's no kind of set minimum, but I would say, you know, we would want to try to avoid probate for that person. And so if it's a person where, you know, they have you know, $3 or $4 million of assets, but most of it is in their primary residence and their retirement accounts, and there's very little outside that's taxable, well, maybe that wouldn't be a big issue, because they might not be subject to probate actually at that point. You know, those assets would already be exempted. So we're really going to look at the asset mix, if that makes sense. And then, you know, we're going to look at their exposure as far as probate goes. But really, it's a very low threshold once you get into assets that, you know, would be subject to probate that can't be directly designated, such as certain, you know, real estate planning or retirement accounts or life insurance or things like that, that can go right to a beneficiary.
Got it. And then also on that same line of thinking, is there any consideration to someone who only dies with a will? Can they avoid probate, or is a will on its own not enough?
A will on its own is not enough. So probate, a will sets forth, you know, your direction. What do you want to happen? But probate is actually the process of making that become valid law, if you will, you know, of exercising that will. And so the court oversees that in a probate situation. And so having a will does not get away from probate at all. The will is used in probate. And that's kind of why that is. So basically, the only way to get around that probate is to have the assets that are transferred, you know, via your will be basically near zero. You know, so there's $100,000 exemption in California. So, you know, let's say there's a bank account and it's under $100,000. Then you'd say, well, what other assets are there? If they get transferred by the will, as opposed to, say, like the retirement accounts we talked about, they have a designated beneficiary, form where you say, I want this to go to X person, you know, for that specific account. That is going to go directly based on that account. It's not going to go based off of your will. Anything that's left over is going to go according to the terms in your will, and that's what would potentially be subject to probate.
Got it. That's helpful. Thank you very much.
Yeah, and you know, as we kind of look at our different planning considerations for today, the main goal that we're talking about is to say, okay, what's your situation? You know, what do you want to plan for? And when we talk about estate tax, gift tax, income tax, you know, as we're trying to do that efficiently. And most of the time, if we think that you're subject to estate tax, we talked about that 40% tax rate, Brian, right? If we think that someone's going to be subject to that 40% rate, then we're going to say, okay, well, hang on. Your estate is already up at a high level. It's already, you know, taxable. How do we mitigate that? Well, we don't want your estate to continue to grow and increase that tax, right? Because we're only increasing, the 40% tax that's going to ultimately come down the road. And so a lot of the planning techniques that we talk about, we're trying to either reduce your estate or to at least freeze that estate. If there's 11.7 million as the lifetime exemption, and you have 12 million in assets, okay, you're over just a little bit. We'd at least want to freeze that at the 12 million. We don't want those assets to continue to grow, which sounds contrary to what you'd want. You want your assets to continue to grow, but we don't, for estate tax purposes, we don't want them to grow in a taxable manner. And so we're trying to figure out a way to say, for your estate tax purposes, how do we stay at 12 million and let your assets grow somewhere else outside of your estate? So any future growth won't be subject to that 40% tax. And we usually call those freezing techniques. That's probably the most common, more advanced planning. Or you might be looking at saying, how do we, get something reduced? How do we provide liquidity, like we were talking about before, something like life insurance or something like that. So let's just jump into some of the other planning considerations here. As we look at, some of those basics, we alluded to this before, there might be a reduced lifetime exemption. We're talking about $11.7 million of lifetime exemption currently in 2021. Now, that came in from the Tax Cuts and Jobs Act. So it started back in 2018. And when that came in, what they basically did was they doubled the normal or the permanent legislation. And so that's indexed for inflation. It's increased a little bit each year. So it's now up to 11.7 million. And it was scheduled to sunset, that doubling was scheduled to sunset for 2026. So in 2026, it was scheduled to cut back in half. And it was originally based off of, again, 5 million indexed for inflation that has doubled. So what we're expecting to happen, we don't know the exact amount, but somewhere about $6 million will be the new number if this passes, starting January of 2022. And so it's almost cutting in half because it basically cuts in half and then we get a little bump for inflation. And so anything between that 11.7 million and that about 6 million, let's call it $6 million that we expect for 2022, that's the area that we're really concentrating on planning right now. So if you're a high net worth individual, if you are above that $11.7 million per person, that's a huge area of potential risk of being subject to that 40% estate tax for you. And if you're above 6 million, we'd project out, okay, you probably have some future exposure to estate tax. Does that make sense? Those two kind of buckets of individuals? Okay. So with that, there's not just the estate tax that we want to consider though, because on the flip side, there are quite a few income tax provisions. And so one of the things that we want to look at is what's the income tax consequence of a planning maneuver versus the estate tax consequence. So if you give some assets away, the gift rules basically say that you have what's called carryover basis. So if I happen to have some stock that I bought, I bought Apple 30 years ago or something like that, and it's gone up a ton over that period of time. If I gifted that to my kids, they might be happy about that. But what's going to happen is they're going to get my basis for tax purposes, for income tax purposes. And so any capital gains that they pay on, they would pay any capital gains since the time that I purchased that stock, okay? Versus if I held that, if I have that Apple stock and I don't have a whole lot of other assets, and let's say I'm, at a couple $1 million, estate value, then my overall estate isn't really at risk for estate tax purposes. And so I don't want to gift. I don't want to reduce my estate in that situation, because we would be better off as a family to have my kids get the step up in basis and inherit that Apple stock, right? They get a step up in basis. There's no income tax on it. And since it's a low enough value, there would be no estate tax. So we need to be concerned about the income tax consequences when we talk about transferring assets. And with the Biden proposals for capital gain property like that Apple stock, there's an increased maximum tax rate being proposed for capital gains. So it's going up, the maximum rate is going up 5% under the current proposed legislation, from 20 to 25%. But then there's some other taxes that you don't necessarily see on there, there's a 3.8% net investment income tax. And then if you're really high income, if it's in a trust, at $100,000 of income, or an individual at $5 million of income, there's another 3% tax being proposed. And so that brings the top capital gains rate up to 31.8% versus the entry level capital gains rate at 0 or 15%. What 15% being kind of the norm that's been used as a capital gains rate for a long time. So that's a pretty significant increase, to 31.8% being a max rate. There's also some other considerations we want to keep in mind as we're considering planning right now, because those capital gain rate increases could be retroactive to September 13th. And so, don't go trying to sell stock now to take advantage of a lower rate, because they put in some language that would make it retroactive or apply to any sales now. I don't know whether that'll survive the final legislation or not. We'll have to see. And there's also some limitations on use of discount valuation. So one of the strategies that's been used for a long time is to say, okay, well, if you're transferring assets and it's in a business entity usually, you can take a valuation discount. So you have $1 million of assets, you can get a valuation done, which might be a costly venture, but they might say, the valuation expert might say, hey, there's a 35% discount on that asset. And so instead of it being $1 million transfer, $1 million gift, it's going to be 65% of that. It's going to be $650,000 gift that you would transfer. So it uses a lot less of your $11.7 million exemption if you're using those discount valuations. Those are being limited. And so if you're thinking about any transfers there, you need to watch out for that. That's mainly for assets within investments, securities, things like non-business assets is what they're trying to address. There's also advanced strategies using different trusts. And folks out there might have heard some of the terms like a GRAT, or, we call them, GRATs, SLATs, IDGITs, and ILETs. We love our acronyms. And so, it might be a GRAT, a grantor retained annuity trust, or an intentionally defective grantor trust, an IDGIT, or we talk about life insurance, irrevocable life insurance trusts, or SLATs, or spousal lifetime access trusts. I'm throwing a lot of those names out there. What all those trusts have in common is they're commonly grantor trusts. And the proposed legislation says that what they're doing is saying any new trusts after the date that this law goes into effect, after the date it's enacted. So not starting 2022, but if this got signed into law November 1st, it would be as of November 1st, whenever the law goes into effect. Then grantor trusts change. And so historically, grantor trusts are planning tools like this, because we could use them to say, here's what you want to happen with these assets, and these are now going to be outside of your estate for estate tax purposes, but they're not separate taxpayers. So for income tax purposes, frequently those grantor trusts, the person, the individual setting it up, is going to continue paying the tax. The grantor is going to continue paying the tax for that trust. And so that is going to change the dynamic between the grantor and the trust. And it could bring them back into the estate. It could cause those trusts to end up having taxable, any distributions of beneficiaries being taxable gifts. It could cause some of those, like there's some strategies where you sell assets to a trust. It could cause those to be taxable sales. You know, there are quite a few different issues there. It could also cause, you know, in the case of a life insurance trust, which is probably one of the more common ones, it could cause any new funding after the date of enactment to, you know, to cause a portion, at least a portion of the trust assets to come back into the grantor's estate. So in the case of life insurance, if someone is going to pay the premiums on a life insurance policy next year, let's say, and this gets enacted, and they go to pay the life insurance premiums, now a portion of the life insurance that ultimately comes into that trust is going to be part of the taxable estate. Where normally, like I mentioned before, our goal would be for that life insurance to be outside of your estate. And so a very important thing to do right now is to review any grantor trusts, especially life insurance trusts or any other grantor trusts that you might have or might be considering, to say, number one, if you have a life insurance trust out there, what do you need to do? Are you at risk? Is it a grantor trust? Is it something that you might want to consider funding all the premiums up front? Or you might want to consider you know, making it not qualify as a grantor trust? Is there a way that you can reform the trust so that it doesn't, so that it becomes an irrevocable trust that is not a grantor trust? Or is there something else you should look at doing? So review grantor trust. That's one of the key takeaways here.
I think, Michael, if I could chime in for a minute on that. I think for people, maybe, because some people might have already made a trust 5 years ago or even 2 years ago. Maybe their estate attorney is no longer practicing. Maybe they've retired. Maybe they've moved. And so, you know, whether you don't have a current estate attorney and you are aspiring to get a new one to replace the old one, or maybe you've never had one to begin with, just a few words of wisdom. You know, as a financial advisor, certified financial planner, you know, I've got enough information in my head to be dangerous, but I always still bring in an expert from at least my local region to the conversation. So even if out there, you know, the listeners don't have direct access to an estate attorney currently, if you have a financial advisor, sometimes they have partners in their network that they might introduce you to, and that might even be a more cohesive conversation between you, your financial professional, and the estate attorney, maybe even a tax person in the same conversation if they're as educated as you are on taxes. So having your team, your stable of professionals around you can sometimes be a good way to approach that, to say, here's my old trust as it was a year, 2, 4 years ago. Should we be changing things today in light of these looming changes? Or like you said, sometimes you have to do all these things before that legislation is passed. So the clock is already ticking. So if you're watching a recording of this, that clock could have already elapsed by now. So I guess the words of wisdom would be, whoever your trusted partners are, go and seek their counsel and say, who can I meet and get in touch with, and start to have this conversation in a quick hurry so that we can get ahead of this.
Yeah, I couldn't agree with that more. You know, this is really a team issue. You know, you really have to look at this holistically. What's the legal side? What's the tax side, you know, and then how do you best manage your assets? What's the financial planning side? And so typically we see the best planning for this done, you know, with the attorney, the tax advisor, the financial planner, all consulting each other. You know, you kind of want everybody to be on the same page and buy off on this, you know, whatever planning you are considering doing. And, you know, probably the first step is to say, what do we currently have in place? Like you said, Brian, you know, where are we at right now and what needs to change? And so it may be that you have a trust that you set up 5 years ago, and whether the law changes or not, based on where your assets are right now, you know, maybe it doesn't need to change at all. it might be fine. But it also could be the opposite, where, you go, oh, goodness, how we set that up. Now we're going to undo, with the new tax legislation, it's going to undo some of what we intended. And so we need to make some changes. And so that's really the recommendation right now, is to get that conversation going early, especially because the timing on this is so urgent. It's always good to have these ideas in mind, to do, to keep the estate planning in the back of your head and revisit it, at least every couple of years, to say, are our plans still appropriate? What's changed? The laws do change, both for state laws, probate and things like that, and then also for income tax and estate tax purposes. A couple other things, as far as what to do now, how to follow up. Look at gifting, in trying to utilize the annual gifts, which right now is $15,000 per year per person. So for a married couple, we look at that and we say, okay, that's $30,000 per person. So sometimes we'll see clients that want to gift to an adult child and their spouse. And you say, okay, you have the parents that want to gift to the son and the daughter-in-law, and it's $15,000 per person. So that's a total of $60,000 that they can gift, or the parents can gift to them. So that's pretty powerful, and that doesn't result in any tax at all, and it just reduces the value of the estate. So that's a good one. Like we said, revisiting your trusts and anything that you have in person, and doing an evaluation as far as where your assets are at and what your basis is in those assets, to see what your income tax impact is versus your estate tax. And so you need to quantify what that exposure is. You might need to get with your CPA or something like that and say, what are my basis considerations here? What's my gain on this if we were to gift something versus, the estate tax exposure? And then note there, watch out for property tax impacts as well, because if you're talking about real estate and you're talking about, okay, we need to transfer some property, that can trigger a property tax reassessment. And sometimes that property tax reassessment might be more costly than the income tax or the estate tax. That's going to be a one-time issue. That might be a more costly approach on the property tax side, which is going to be every year. Now you're paying more in property taxes. So you need to consider other items too. I'm looking at those irrevocable life insurance trusts. Watch out for the grantor status. You probably don't want to set up any grantor trust for life insurance if they're going to have any continued premiums. Considering on the advanced side, if you want to consider something, if you're a high net worth individual, if you are well over that $6 million per person, and you may be subject to estate tax down the road, then that's where you want to consider some of those advanced trust strategies right away. Some sort of grantor trust strategy is going to have a very limited time window to get set up and get funded before these laws get enacted. So those are things to be looking at right away. If you're think you have exposure and you're willing to make the moves right now, but keep in mind, you don't want to do this and then regret or need to change it later. And so, you always talk to your professionals that you've worked with, if you know them, or consider what you want this to look like. Always look, have the end in mind, essentially, and don't just go creating trusts or gifting things away, because sometimes we see unintended consequences and it ends up worse down the road than better when you're just trying to make some moves quickly.
And I would say a couple of quick thoughts on this too is, some of you out there might be thinking to yourself, oh, $11 million, that's more than I have, or that's more than I'll ever have. But then also consider 6 million is the proposed legislation coming back to, potentially in the near future, 6 million. And it might hang there for a while if that's where it ends up. So consider the rule of 72. That's the old rule that says, how many years does it take for my asset to double in value, assuming a proposed rate of return? So let's use the rule of 72 says if my rate of return is 7% on real estate, or my stock portfolio or investment portfolio. Divide that into 72, 7% goes 10 times roughly. So that's 10 years. So your assets, whatever your total estate is today, consider that if it grows by 7% per year, it doubles in 10 years from now, and it will double again in another 10 years. So that might not take as long as you think to get to 6 million, depending on where your estate currently is. So along this entire, 40, 50 minutes we've been talking, if you were always thinking, oh, that's for other people, it may not be, depending on what number you're actually at. So it's worth taking a close look at.
Yeah, and there's even as we look at some strategies right now, there's even some things to consider if you're well below, and especially depending on generation where you're at or where parents are at. Sometimes we're seeing planning go the reverse way and say, well, there's a lot of room. We have some of that old Apple stock, right? And maybe you're not gifting that to the kids, you're gifting that to the grandparents, because in their estate, it's going to have a step-up basis, and you're well under the 6 million, and you can get that step-up basis that way. So there are some interesting strategies, Brian, when you think about that both ways, really. So this isn't something to just quickly dismiss. There are some strategies no matter where your asset levels are.
I want to break in here. We usually have some time for question and answer, but we are coming right at the end of our time. Well, maybe Brian, if you can pick one or two questions and we can quickly answer those. And then if anyone else, if we don't get to your question, go ahead and leave your number and we'll make sure someone reaches out to you.
Yeah, I'm seeing one question here that just came in that I think is germane, and she asks, the $6 million is per person. Yes, that's true. And then could we set up 2 trusts, 1 per spouse? Michael, do you have any thoughts on that particular question?
Yeah, and you could. So there are a lot of different variables in terms of how you can set things up. And I do want to caveat you should talk to your legal and tax professionals, because it in part depends on your jurisdiction and where you live and what kind of property you own for the 6 million. So whether it's separate property or community property, that can vary by place or how you receive those assets. But in general, when you set up a trust, you could set up, if you're a married couple, you could actually set up a trust that covers both of you. You could set up your own separate trusts, or you could set them up together. So either way is possible. And it really depends on, what you want to do with each person and what kind of assets you have coming in, what'll best cover your situation. But most of the time, what I see is that as one trust that's set up to cover both people, separately. And then the 6 million isn't per trust, it's still per person, even in that case.
Well, thank you so much. I think we could probably talk forever on this topic. It's definitely, you guys are both passionate about this kind of information. We're really glad that you've been able to share that with us. And on behalf of Advice Chaser, thank you to Brian and Michael for being here, and also the organizations that have made this event possible today. Those of you who are attending, look for your email for a replay of this event. You're welcome to share that replay with friends or family. We'll also be hosting the recording on our website at advicechaser.com. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. So once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.